Imagine you're 25 years old. You decide it's finally time to take investing seriously. You look at your monthly budget, cut down on a few unnecessary expenses, and commit to investing 20,000 rupees every month. Because one day, you want to see your portfolio cross 1 crore rupees. But then, you face a decision that could have a bigger impact on your journey than the amount you invest. Should you simply buy a nifty index fund every month? Or should you spend your time picking individual stocks? Most people don't hesitate. Of course I'll pick stocks. Why settle for average returns? If I can find just one multibagger, I'll reach 1 crore rupees much faster. It sounds logical. In fact, it's exactly what millions of investors believe. But what if I told you that this one decision has probably cost investors more wealth than any market crash? Today, we're not going to debate opinions. We're going to look at decades of market history, real investor behavior, and data from the Indian market to answer one simple question. If your goal is to build your first 1 crore rupees, what's the smartest path to get there? Stick with me. By the end, you'll see exactly what that 1 crore rupees actually looks like, month by month.
Let's start with a simple thought experiment. Imagine 2 investors. Let's call them Rohan and Aman. Both start at the age of 25. Both invest exactly 20,000 rupees every month. Both stay invested for the next 25 years. The only difference is how they invest. Rohan buys a simple nifty index fund every single month. No predictions, no stock tips, no business channels, no trying to time the market. Just one boring investment, month after month. A nifty index fund isn't one product, it's a category. Funds like UTI Nifty 50 Index Fund, HDFC Nifty 50 Index Fund, SPI Nifty Index Fund, all doing the same job, mirroring the Nifty 50 at a very low cost. Prefer trading like a stock? Nippon India ETF Nifty 50Bs, India's oldest Nifty ETF, does the same thing. These are examples, not recommendations. The strategy matters more than the exact fund. Aman takes a different path. He believes he can do better than the market. He spends weekends researching companies, reads annual reports, listens to earnings calls, tracks market news every day. And honestly, there's nothing wrong with that. In fact, most of us believe that putting in more effort should lead to better results. That's how life usually works. Study harder, score better. Practice longer, play better. Work harder, earn more. So naturally, we expect investing to follow the same rule. More research, more effort, better returns. But what if working harder doesn't necessarily lead to better results in investing? What if the biggest challenge isn't finding great companies, but accepting that you may not need to? That's the question we're going to investigate.
So, how do we answer that question? Let's not start with ordinary investors. Let's start with the professionals. After all, if anyone should consistently beat the market, it should be them. Professional fund managers have research teams, access to management, and this isn't a hobby. It's their full-time job. So if stock picking really works, they should outperform year after year, right? Well, every year, S&P Dow Jones Indices publishes the SPIVA India Scorecard. It compares actively managed Indian mutual funds against their benchmark over 3, 5, and 10 years. And as the period gets longer, more active funds fail to beat the index. In India, over a 10-year period, roughly 3 out of every 4 large-cap funds underperformed their benchmark. These are professionals with research teams and information most of us don't have, yet the majority still couldn't consistently beat the market. You might expect this to be a large-cap problem. Big companies, efficiently priced. What about mid-cap and small-cap, where information is less widely tracked? Same story. Over that same 10-year period, mid-cap and small-cap funds underperformed at an even higher rate. So here's a question. If professionals struggle to outperform, what makes us so confident that we can? That's not meant to discourage you. It's meant to make us pause. Because maybe the biggest challenge in investing isn't choosing the right stock. Maybe it's choosing the right strategy.
If all of this sounds too theoretical, let me tell you a story. In 2007, Warren Buffett made a $1 million bet. Not on Apple, not on Coca-Cola, not on any individual stock. His bet was much simpler. He believed that over the next 10 years, a low-cost S&P 500 index fund would outperform a portfolio of hedge funds selected by protege partners. Think about that. On one side, a simple index fund. No stock picking, no market timing, no expensive research. On the other side, a basket of hedge funds chosen by professionals whose job was to beat the market. If anyone could win, it should have been them. 10 years later, the results were in. The S&P 500 index fund had returned about 125.8%. The hedge fund portfolio, about 36.3%. Buffett won the bet. But more importantly, he proved something far bigger than winning $1 million. The more people try to outperform the market, the harder it becomes to actually do it. Because every extra decision you make, which stock to buy, when to sell, when to hold cash, creates another opportunity to make a mistake. Sometimes, the simplest strategy isn't just easier, it's smarter. But before you conclude that index investing is always the answer, there's one more piece of evidence we need to look at. And this one comes from our own market.
Now here's where it stops being theory and starts being your money. Let's go back to Rohan. Every month, without fail, 20,000 rupees gets invested into the Nifty, no matter what the headlines say, no matter whether the market is up, down, or doing nothing at all. Now, before we look at the numbers, these projections assume Nifty's long-term historical average return of around 12% annually. That's not guaranteed for the future. Past performance never is. But it gives us a realistic picture based on decades of actual market history. Look closely at what's happening. For the first 5 years, you invest 12 lakh rupees. Your portfolio grows to about 16.5 lakh rupees. It feels slow. After 10 years, you've invested 24 lakh rupees. Your portfolio is worth around 46.5 lakh rupees. Now things start getting interesting. By year 15, something remarkable happens. Without changing your SIP, without picking a single winning stock, your portfolio crosses 1 crore rupees. 5 years later, it's nearly 2 crore rupees. And by year 25, the same 20,000 rupees monthly SIP has grown to almost 3.8 crore rupees. Notice something. You invested 60 lakh rupees out of your own pocket, but your portfolio grew by more than 3.2 crore rupees. That's the real power of compounding. Not because you found the next multi-bagger, not because you timed the market perfectly, but because you gave time a chance to do the heavy lifting.
Now let's change just one thing. Increase your investment as your income grows. Think about your annual appraisal, that increment you get every year. What if your SIP grew by that same simple 5%? That's it. If you start with an SIP of 20,000 rupees a month, next year it becomes 21,000 rupees a month. The year after that, 22,050 rupees. A small annual increase that most people can manage as their salary grows. Now watch what happens. After 25 years, you haven't invested 60 lakh rupees anymore. You've invested about 1.15 crore rupees. But your portfolio grows to almost 5.5 crore rupees. That's nearly 1.7 crore rupees more than a fixed SIP. You didn't find better stocks, you didn't time the market, you simply made sure every salary increment wasn't spent entirely on a better lifestyle. A small part of it was invested. This is how ordinary incomes create extraordinary wealth. Not through dramatic decisions, but through small improvements repeated every single year.
But there's another cost that almost nobody talks about. And it's much bigger than a bad investment. It's the opportunity cost. Imagine you spend your first 5 years chasing the next multi-bagger. Some stocks work. Many don't. Your portfolio barely grows. Now you decide to switch to index investing. Sounds harmless, right? Not quite. Because compounding doesn't just reward good returns. It rewards an early start. Those first few years are the most valuable years of your investing journey. Every year you spend following the wrong strategy is a year your future wealth can never fully recover. A delayed start doesn't just delay your first crore. It shrinks every crore that comes after it. That's the hidden cost of bad investment decisions. Not the money you lose today, the money that never gets the chance to compound.
And there's one more cost. This one doesn't even appear in your portfolio. To consistently beat the market, you need to read annual reports, track quarterly results, follow industry news, watch management interviews, study valuations. Repeat this for years. Now ask yourself a different question.
What if those same hundreds of hours were invested in becoming better at your own profession, learning a new skill, getting promoted, starting a side business, negotiating a higher salary? Because for most people, their biggest wealth-building asset isn't their portfolio, it's their ability to earn. A 20% salary increase often adds far more wealth over a lifetime than trying to earn an extra 2% by picking stocks. Maybe the smartest investment isn't spending every evening trying to beat the market. Maybe it's building a career that allows you to invest even more into the market, because your salary buys the units, and those units create the wealth.
Let's go back to where we started. A 25-year-old, a 20,000 rupees monthly SIP. One dream, to build the first 1 crore rupees. We looked at decades of market history, the behavior of professional fund managers, the psychology behind our investment decisions, and one thing became clear. Building wealth isn't about making the smartest prediction, it's about making the fewest costly mistakes. So if you're just starting your investing journey, here's a simple framework. 1. Make consistency your superpower. Invest every month, whether the market is up or down. 2. Let time do the heavy lifting. Compounding needs years, not weeks. Don't interrupt it. 3. Increase your SIP as your income grows. Even a 5% annual step-up can add crores to your long-term wealth. 4. Protect your attention. Spend less time chasing stock tips, spend more time growing your career. For most people, their salary is the engine, their investments are the fuel. You need both. 5. Keep investing simple. The simpler your strategy, the easier it is to stick with it during difficult times. If you don't have an SIP running yet, that's the only homework from this video. Not research, not analysis, just one SIP started today. Remember, your first 1 crore rupees probably won't come from finding one extraordinary stock. It will come from hundreds of ordinary decisions made month after month, year after year. Because in the end, wealth isn't built by predicting the future, it's built by staying invested in it. One quick note before you go. This video is for education, not personalized investment advice. Mutual funds are subject to market risks. Please consult a registered financial advisor before investing. If this video changed the way you think about investing,
Share it with someone who's just beginning their journey. It might save them years of expensive mistakes. And if you'd like to see more videos backed by data, psychology, and real market history, consider subscribing. I'll see you in the next one.